All right, guys, let's get into the video directly. No fancy edits or anything else like that. I want to get this information directly to you about SOFI's earnings because they just went down this morning. And guys, there's a big problem that I see lurking out there. And so I need to address it right now today with you guys. So make sure you like the video if you like getting the truth without the hype and not all the sunshine and, unicorns and everything else that's out there a lot of times in a lot of YouTube videos. You guys are going to get the straight talk right here about these earnings. Now, what we're going to watch today, I actually released to my group this morning. So, I try to do that anytime, especially when I see a big problem there. I like to get that out to my members immediately there. You can be a member for as low as $15 there. So make sure you check out the pinned comment down there for a membership because those spots are going quickly. We're well past halfway now in regards to those spots being available. But nonetheless, it was one of those things to where it was definitely something that stuck out there. I think I needed to address not only the earnings, what the reaction to the earnings was, what some of the problems with our own reactions personally as, retail investors to those earnings. And of course, the big problem that I saw there. But it was important enough that I was like, hey, let me go ahead and get this over to my YouTube folks as well there. Appreciate you guys' support there with the channel. So here it is. I'm just going to give it to you guys straight. And just remember, check out the pinned comment down there if you feel like you want a membership to the group and you want access to stuff like this early, or in some cases, I don't release these at all on YouTube. It's just exclusive to the group there. But here's the video. Check it out. All right, guys. So let's talk about SOFI's earnings that just went down there. And I just got done listening to the call there. And so there's some things that I kind of want to point out to you. The first thing I really want you guys to focus in on, go back and listen to the call. Don't listen to me. Told you guys, don't listen to reaction videos, other people's recaps or anything else like that. Although I'm giving you one, I understand that. But nonetheless, go through and listen to the call. You'll see very well organized. You notice the way people answer questions. Not only would they say, I'll take that, but they would also say things like, and then Anthony will answer this piece of your question. I'll answer this piece of the question, and then Anthony will answer that other piece of the question. That comes because everybody prepped ahead of time for this earnings call. Generally, kind of the questions you're going to get asked. And it was kind of everybody was assigned a role. If it's this question, Steve's going to answer. If it's this question, Brenda's going to answer. I'm just using fake names. I can't remember the names that were on the call. But nonetheless, that's the way you prepare for an earnings call. So when the time comes and you're asked a question, you don't end up with 15 minutes worth of rambling on something that's, very much in the future or, discussing things that don't really have anything to do with the question or anything else like that. You stay very focused. You stick to facts more importantly, and you don't end up with kind of this jumbled call where everybody's kind of, sometimes stepping on each other and some other things like that. You see a very well organized, very disciplined call. Everybody's on point. That's how you prep for an earnings call there. So a little bit different there in regards to what we heard last week. There were a lot of great things on this earnings call, but there is one massive problem that I noticed we'll talk about here in just a second there. And there's also a big lesson as well for everybody in the group here, something I saw popped up in the group this week here. There's a big lesson there to be learned. We'll talk about that as well. But let's jump over to kind of the highlights first of everything that I kind of saw that really stuck out to me in this earnings call. And the first one is they're still using the raise and beat strategy. It's a great strategy. Obviously, they blew it out of the water again, and then they raised guidance again. Those are all very, very positive things. Now, and it doesn't seem like Wall Street's caught on at all. That's exactly the game that, Anthony Noto plays. He basically, gives guidance, they beat it, and then he raises it again, rinse and repeat now for, I don't know. We got to be past 10 quarters now of this happening. And again, they did it once again, right on target with exactly what they do. And to me, I don't mind it right now. At some point in time in the future, as it gets covered by more and more Wall Street folks, people will start to catch on to the game, I guess. But either way, it's a better strategy than, obviously over-promising and then under-delivering. But that's good news there. But of course, we also saw that one-time benefit that they got from the restructuring of the loan debt and all that sort of stuff way skewed the numbers to the positive, obviously. That's why you saw the algorithms pump it up, right? As soon as the numbers were released, guys, nobody's sitting there. Nobody has enough time by the time the algos react to, read everything, digest it, and then trade based upon that. All it was they saw a massive number on the beat side, and immediately the algos just went crazy. The traders went crazy. Everything kind of went crazy there for a second. That's why you saw the huge run up in the stock as soon as numbers were released. And then as people started digesting the numbers, realizing that was from a one-time charge, not just a growth in the business, not a one-time charge, a one-time benefit. It was from that, not from growth in the business there. That's when you started seeing it trade back down. And of course, that means the momentum's going the other way, which, what do traders do, right? They're going to beat down the momentum and take it the other way. Does it matter to me? No, it's just traders being traders in the end. But I wanted you guys to be aware that one-time charge was in there this time, and it's not going to be there next time. So we're going to be back to normal numbers there. Although I'm sure there's somebody going to be out there going, "Oh my gosh, this is an incredibly greatest ever," and they'll totally gloss over the fact there was a one-time charge there. Don't do that. You can basically just take out that number, extrapolate what the numbers would be. They still would have been positive. Everything still would have been on track, and everything's okay there. So kind of the next note that I have here is we'll talk about this a little more in depth here in just a second. But they did talk about potential partners in tech. They have a lot of folks kind of lining up. They're in negotiations or talks, I believe it's how it was phrased, with a lot of different folks for the tech platform itself. That is going to be huge. But again, we'll talk more about that here in just a second because there's a little bit more detail to it. But it was something that was in the write-up there, and I wanted to make sure I pointed out that is a section that I'm paying especially close attention to. And again, we'll talk about why here in just a second. Let's see here. Fourth note, this is why it's trading down, in case you guys are wondering. One of the reasons, not the whole reason, but Q2 guidance was weak. And we can't deny that. We can't say that's not what happened because they did. They guided weak. Now, the good news for all that is they still actually raised the guidance for the year, which means it's still a beat and a raise. But you got to remember, guys, we are dealing with Wall Street. And although they gave a raise for the end of the year, which of course means they're going to have better profitability at the end of the year versus what they thought they were going to have, Wall Street seems to not care. They care about the now, and for now, they're saying next quarter is not going to be as great as we originally thought it was. You guys know just as well as I know, they're going to beat it down for that. But all that up and down in the price kind of takes me to that big lesson I want you guys to hear. We'll get to the last point here and then on to the big problem that I see. But that's why I always tell you guys, don't play games around earnings. They make no sense. This is just the way Wall Street operates. I know we had some folks trying to play earnings games and betting that it's going to go up or it's going to go down, all that sort of stuff. You guys were on a roller coaster this morning. And unfortunately, just in the end, you're playing against, no crazier option plays happen than around earnings. You got all the algorithms. You have, obviously all the pro traders trying to play games. A lot of the big pros don't mess around with earnings at all because they're so volatile, they're so ridiculous, and they make no sense. We don't know how or what everybody kind of positions, and you think Wall Street coordinates and all that sort of stuff. They don't. They basically set up their options one way, and then it goes the opposite way of their options. They have these other new plays that jump in there and do it. So it's kind of like everybody's kind of got multiple things set up, and that's why you see these wild swings up and down and madness kind of happening per se around earnings, because stocks are never more manipulated than around earnings. So the big lesson I can tell you guys is don't play games around earnings. I didn't do it with Tesla. I had no idea where Tesla was going. I bought according to my plan. I bought at 141 because that's what my plan said. I'm glad that I did. But if the trade would have gone against me and it would have gotten beaten down to 120 or 110 or whatever the case was, cool. I would have followed my plan again. But that is far different than trying to play a game of, all right, I'm going to buy a bunch of shares thinking it's going to skyrocket after earnings. And then when it doesn't happen to you, now you're just forced to get out of that trade, lose money, and move on. And that's just a very, you're playing, not only are you not trading correctly in regards to how to actually make a swing trade or a day trade, you're playing against the time when even the pros don't like to play because of all the stupidity and all the ridiculous games that go on. So don't play those games there. Don't get caught up in those games. So that's my thoughts on that. So number 5 here is be prepared. They were prepared for higher for longer. So they talked about it a couple times actually on the call that, basically at the beginning of the year, everybody was pricing in, 6 rate cuts for the year, starting as soon as March. I'm sure we all remember that. Now, right here, we were talking about that's stupid. We might get 1, 2, 3 was the max that I was willing to go in regards to rate cuts this year. And I thought all of them would be at the back half of the year after we've kind of proven everything out. But it's Wall Street. They get dumb. They want to trade a certain way. They want to pump stocks. They want to dump stocks, whatever they're doing. That right there's the narrative. They addressed that several different times, but they basically said, we are prepared for higher for longer. Basically saying they didn't buy the narrative either. They just kept steady. They didn't decide to get riskier because they thought rate cuts were coming faster or anything else like that. They decided to stick with being cautious, which is a good move. JP Morgan did the same. Most of the big banks did the same exact thing. So very, very good move there. They are prepared for higher for longer. So anybody talking about, oh, what's going to happen if the Fed doesn't cut rates this year? How's that going to affect SoFi? They're already prepared for it. So ignore those type narratives when you hear that sort of stuff. No, that person clearly didn't listen to the earnings call like we talk about and didn't pick up on that little note there. Some other odds and ends, really the only odd end that kind of jumped out to me was just they basically said no more share dilution. We're not going to see it anymore. They don't need to raise capital at this particular point in time for any reason. They actually have excess capital in reserve if the Fed does decide to, relax standards a lot faster or anything else like that that happens that's positive, they have the capital to unleash in order to take care of that. Or if things get a lot worse, they're not going to need the raise in order to continue to execute as a business. They were very, very specific about that as well. So no dilution coming anytime soon that we can see there. Now, of course, things can change, but again, right there in the earnings call, we heard it from the horse's mouth. No more dilutions coming there. But this kind of leads me into the one big problem that I had with these earnings. It's not a problem with the earnings. It's one big problem that I see for SoFi long term, not just short term. Short term, I don't really think it's that much of a problem. It will in the traders' minds, but I don't care about the traders. Long term, this is a problem for SoFi, and that is you are not seeing the tech platform giving us the kind of growth that we're seeing in other places. Now, why does that matter? It matters in a massive way because that is what is going to give us the fintech multiple versus the bank multiple. Because right now they are crushing the banking industry, the banking side of the business. They're destroying it. They're outpacing everyone, including the big banks, including some of the smaller banks. They are destroying people in that deal. The growth is there for now. Now they're seeing some other things over here kind of on the tech side that are moving. They're moving along nicely, but they need some big partners to come on board, and they need more. They need that growth to basically accelerate more than what it is right now in order to get that fintech multiple that we want. Because if they continue to crush it on the banking side and that other side kind of, kind of see the pendulum kind of tilt, hey, here's traditional banking. It's going up, 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 up. And this is growing as well, or I guess I should do it this way. So this one's growing, and it's just growing at a faster pace. Now I understand they're more to even right now, but we need these to be 50-50. We basically need half of it to be coming from that tech side, that other side of the deal, the fintech side, and we need the rest of it to come, and we need that banking to kind of come directly in line with it. Now, obviously, you'll have some jostling back and forth, but we saw the same thing with Palantir, right? It would be crazy growth on the commercial side, crazy growth on the government side. Nobody was happy there for a while because it would kind of flip-flop, flip-flop, flip-flop. And now it's kind of like, okay, it's all growing. We're seeing massive growth on both of those. And what it does is it kind of eliminates that, and it allows you to come up with a better multiple and to better define what Palantir is in regards to where the growth is going to go. Everybody kind of understands that, hey, they're going to grow on both. And they've proven that over time. SoFi is kind of in that weird conundrum right now where everybody's trying to figure out, hey, is it a bank? Is it fintech? Nobody knows right now, and there isn't a good answer to it. I honestly cannot give you guys a real answer as to how Wall Street is going to place the valuation on it. But I can tell you, if the bank segment continues to explode and we see the fintech lag kind of behind a little bit there, they're going to get assigned more of a bank multiple. Now, I don't think they're going to go all the way over regardless to a complete bank multiple, but that definitely lowers the value of the shares. Matter of fact, if they decided we're going to value it like a bank, it is overvalued right now. Those are just facts. It just is. Obviously, you can pull, I see this a lot whenever I say something like that on my videos. Folks will go, oh yeah, but what about this metric? Right there, they're undervalued compared to JP Morgan. Oh, okay. Maybe so, but according to other metrics that Wall Street uses, it's significantly overvalued. So you can't cherry pick your metric to go for that. And more importantly, even if it is trading cheap on a particular metric to JP Morgan, the facts are you're still not getting that fintech multiple that really is going to make us a lot of money there. So that's kind of my one big concern there that we've got to see. We've got to see the tech platform start really signing up, improve that growth rate. A couple of big partners can accelerate that growth rate a ton. Really, really juice it. It's not like you need 10 or 100 or anything crazy like that. You just need a couple of big partners there to jump in, come on, and then see that growth really accelerate there for us to really kind of see, okay, there is a fintech component here that is absolutely growing like the other side. And I think at that stage, that's when you'll kind of see that multiple expand out for us. So it's not there yet. It's not definitive yet. It's not like, oh my gosh, I need to panic and sell all my stock. You guys come here for the truth. And that's exactly what I'm giving you right now. That's my concern is I'm seeing rapid growth in a lot of traditional banking products, and the fintech stuff, although it's growing, don't get me wrong. We just aren't seeing. They keep talking about partners. They keep talking about we're in discussions. And it's like, hey, you guys need to land some of these guys. You guys need to start bringing those things forward and start having it actually come to fruition in the earnings itself. Do I think they can do it? Absolutely. They have done nothing but execute overall. But in terms of something that I'm watching, that's kind of something that I'm watching there to make sure that we're getting that growth there. Again, it's not something that's going to make me want to sell out or anything like that right now. It's too early. They're too young. They're too early in all these stages in order to get there. But is it a concern? Yeah, it is something that I'm definitely keeping my eye on per se. And I think some of the bigger players on Wall Street who obviously they're liking what they're seeing, but remember, they're trying to figure out, hey, what multiple do we want to pay for this when they're looking, obviously at the asset itself right now. That right there is something that's kind of got them kind of leaning more towards a lower multiple, as opposed to if we start seeing some big partners come in or something like that on the tech side, they'll start leaning more towards that fintech multiple, basically be willing to pay more for the stock than they originally thought they would have because they're seeing growth in those other areas. So, and remember, for just $15, you can be a part of my group and see the $250 legacy challenge in real time. Or if you want to be able to talk to me, take 5 courses for free, use our stock analyzer tool for free, be a part of the best 6, 7, and 8 figure Discord out there. We got free coaching, all kinds of stuff for full members. That's on sale as well. So make sure you check out the pinned comment down there and see if a membership's right for you. And click this video here if you want to see exactly what I'm buying in this market. And click here to see my exact plan for this market. So thanks for watching, and we'll see you in the next one.